The average monthly car finance payment in the United Kingdom in 2026 is approximately £244 per month. The full new state pension is £241.30 per week, which is £1,045 per month. That means the average car finance payment for a UK pensioner represents approximately 23% of their state pension income before a single bill, a meal, or a prescription has been paid. I want you to sit with that figure for a moment. Nearly a quarter of the average UK state pension going to a car finance company every month for a depreciating asset, on a fixed income, with no prospect of the income rising faster than the car's value falls. I am not here to tell you that you should never have a car. A car provides independence, access to medical appointments, connection to family, and quality of life that matters enormously in retirement. I am here to tell you that the specific financial mathematics of carrying a car finance agreement on a state pension and modest retirement income are dramatically different from the mathematics of carrying one during your working years, and that the UK car finance industry has specific practices that are worth understanding before you sign anything. My name is James Whitfield. I have spent 16 years as an independent pension advisor, and the car finance conversation comes up more often than most people would expect in a financial planning context. Let me walk through the numbers, the specific traps, and what the alternatives look like. The true cost of car finance in retirement goes well beyond the monthly payment. A monthly car finance payment of £244 sounds like a specific, manageable number. But that number does not capture the complete financial picture. Let me explain what it actually costs. On a £15,000 car financed over 48 months, the total repayable at the average UK rate is approximately £17,500. The difference, £2,500, is the interest cost. That is money paid to the finance provider simply for the use of their money, in addition to the cost of the vehicle itself. But the opportunity cost goes further. The £244 leaving your account every month is money that is not sitting in an individual savings account earning 4 to 5% tax-free. It is not in a premium bond earning a tax-free return. It is not in a competitive, easy-access savings account. Over 48 months, £244 per month is £11,712 in total payments, plus £2,500 in interest, equals approximately £14,200 in total cost. If instead you had kept that same £244 per month in a 4% cash ISA for the same period, the account would grow to approximately £12,900. The difference between having paid the finance agreement and having saved the equivalent amount is a gap of over £25,000 in net worth after 48 months. Now let me address the specific issue with personal contract purchase agreements, because PCP is the dominant form of car finance in the United Kingdom, and it has characteristics that make it particularly problematic for pensioners on fixed incomes. A PCP agreement works as follows. You pay a deposit, typically 10 to 20% of the vehicle's value. You make monthly payments for an agreed term, typically 24 to 48 months. At the end of the term, you have 3 options. Return the vehicle and walk away. Pay a balloon payment, called the Guaranteed Minimum Future Value, or GMFV, to own the vehicle outright, or use any equity you have accumulated as a deposit on a new PCP agreement. The PCP model is designed to keep you cycling through new vehicles on an ongoing basis, because the balloon payment at the end is set high enough that most people cannot pay it, and instead use the third option, rolling into a new agreement. The finance provider benefits from a continuous stream of interest-paying customers who never fully own their vehicles. For a pensioner on a fixed income, the PCP cycle creates a permanent recurring monthly expense with no endpoint. Unlike a hire purchase loan that ends when the final payment is made and leaves the borrower owning the vehicle outright, a PCP agreement typically ends with the pensioner either walking away from the vehicle with nothing or entering another finance agreement to stay mobile. The Financial Conduct Authority conducted an investigation into the UK car finance market, and a major ruling in 2024 found that hidden commission arrangements between dealers and lenders had resulted in consumers being charged higher interest rates than necessary. The Supreme Court upheld this ruling, creating a potential redress scheme for millions of UK consumers. If you took out car finance through a dealer between 2007 and 2021 and were not told that the dealer received a commission from the lender, you may be entitled to compensation. The claims process is ongoing, and most major UK banks are processing claims. Contact your original lender to ask about the redress scheme. Now let me address the specific situation of pensioners who are currently in car finance agreements that are straining their budget. The first option is refinancing. With the Bank of England base rate having fallen significantly since its 2023 peak, competitive car refinancing rates are available. If you originally financed your vehicle at a rate above 8% and you have maintained a reasonable credit history, refinancing at a lower rate through a credit union or a direct lender rather than a dealer may reduce your monthly payment and total interest cost. Credit unions in the UK offer among the most competitive rates for personal loans and vehicle finance. The Association of British Credit Unions Limited website at abcul.coop can help you find credit unions in your area that you may be eligible to join. Credit union membership is often based on where you live, where you work, or your membership of certain organisations. Once a member, you typically have access to loan products at rates significantly below the high street banks and well below dealer finance. The second option is voluntary termination. Under Section 99 of the Consumer Credit Act 1974, you have the right to voluntarily terminate any hire purchase or PCP agreement after you have paid at least half of the total amount payable, or by paying the difference to reach 50% if you have not yet reached that point. This right cannot be taken away by the finance agreement and applies regardless of what the contract says. Voluntary termination ends the agreement, requires you to return the vehicle in reasonable condition, and results in no further payments being required. If you have paid more than half the total amount payable on your agreement and the vehicle is a financial burden, voluntary termination is available to you as a legal right. It will affect your credit file, but for a pensioner whose primary financial concern is monthly cash flow rather than future borrowing capacity, this may be the most practical solution. The third option is selling the vehicle if the outstanding balance is less than its current market value. If you owe £8,000 on a vehicle that is currently worth £11,000, selling the vehicle settles the finance and leaves £3,000 in your hand. The current used car market in the UK remains relatively strong for many popular models. Sites including Auto Trader and We Buy Any Car provide instant valuations that allow you to assess whether your vehicle has positive equity. Now let me address the alternatives to car finance that work specifically well for UK pensioners. Buying a reliable used vehicle for cash is the most financially sound approach for a pensioner who has savings. The used car market in the UK offers reliable vehicles with under 50,000 miles at price points between £8,000 and £15,000. A vehicle purchased outright from savings eliminates the monthly payment, eliminates the interest cost, and provides the same transportation function as a financed vehicle. For a pensioner with savings of £30,000 or more, spending £10,000 to £12,000 on a reliable used vehicle is a straightforward decision that eliminates a monthly expense permanently. For a pensioner with more limited savings, the comparison between paying interest on a loan versus using savings to avoid the loan requires careful thought, but the interest cost avoided is almost always more valuable than the return the savings would generate if left in a standard account. Keeping the existing vehicle longer is often the most cost-effective option. Modern vehicles, properly maintained, routinely reach 150,000 miles without major mechanical failures. A pensioner driving a 10-year-old vehicle in good condition has, in many cases, a vehicle that will provide reliable service for another 5 to 8 years. The cost of maintaining an older vehicle, even including 1 or 2 significant repairs per year, is almost always lower than the annual cost of a finance payment. Specific to the UK, many independent garages offer competitive servicing and repair costs compared to manufacturer dealer networks. Having a trusted independent garage that knows your vehicle can keep maintenance costs lower and provide an honest assessment of the vehicle's condition and longevity. For UK pensioners who qualify for the Blue Badge scheme, free or discounted parking is available in many areas, which reduces one of the ongoing costs of car ownership. And for pensioners who no longer drive frequently, car clubs and services such as Zipcar or similar local schemes provide access to a vehicle when needed without the fixed costs of ownership. Let me also address the car insurance dimension for UK pensioners, because this is a significant ongoing cost that interacts with the finance decision. Car insurance premiums for drivers over 70 have historically been higher than for middle-aged drivers, because statistical claims rates for older drivers increase beyond that age. However, significant differences exist between insurers in how they assess older drivers, and comparison sites including Compare the Market, Go Compare and Money Supermarket provide a starting point for finding competitive premiums. Many UK pensioners are also eligible for Motability Scheme vehicles if they receive the higher rate of the mobility component of personal independence payment, or the higher rate of the mobility component of disability living allowance. The Motability Scheme provides a new vehicle every 3 years in exchange for a weekly mobility payment handled automatically through the benefit. For eligible pensioners, the Motability Scheme eliminates the finance and insurance complexity entirely. Let me close with the practical framework for any UK pensioner considering a vehicle decision. What is the total cost of this finance agreement, including all interest, fees, and any optional extras? What percentage of my monthly income from state pension, pension credit, and other sources does the monthly payment represent? If that percentage is above 15%, is a less expensive vehicle or a cash purchase a realistic alternative? What is the current market value of my existing vehicle, and how many miles and years of reliable service does it likely have remaining? And what would the money currently going to a finance payment do for my financial position if it were instead directed to savings each month? Running those questions before signing anything takes less than an hour. For a decision that will affect your monthly budget for the next 3 to 4 years, that hour is well spent. Send this video to one person in your life who is over 65, currently making car finance payments, and has not reviewed whether those payments represent a manageable percentage of their retirement income. I will see you in the next one. Let me go deeper on several aspects of this topic, because the practical details make a significant difference to whether the actions I have described are available to you and how to access them effectively. On the FCA Car Finance Redress Scheme, I want to give you the specific information needed to make a claim, because this is a live opportunity that many pensioners do not know about. The Supreme Court ruling in October 2024 found that dealers who received hidden commission from lenders, called discretionary commission arrangements, had acted unlawfully. The lender was also found to be liable. The affected finance agreements were those taken out between 2007 and January 2021, when the FCA banned discretionary commission arrangements. The specific type of agreement affected is hire purchase and PCP agreements taken out through a dealer rather than directly through a bank or credit union. If you visited a dealership and signed a finance agreement with a lender the dealer arranged for you, it is likely that a discretionary commission arrangement was in place. To make a claim, contact the finance company that provided your loan directly and tell them you believe your agreement was affected by a discretionary commission arrangement and you wish to make a complaint. The finance company is required to investigate and respond. If they reject your complaint or fail to respond within 8 weeks, you can escalate to the Financial Ombudsman Service at no cost. The FCA has set a deadline of December 2026 for affected consumers to submit complaints to their lender. If you had car finance through a dealer between 2007 and 2021, you have until December 2026 to start this process. Acting sooner rather than later is advisable, as the process can take several months. The potential redress for a successful claim is the difference between the rate you actually paid and the rate you would have received without the secret commission, plus interest. For a £15,000 vehicle financed over 3 to 4 years, successful claims have resulted in compensation of several hundred to over £1,000, depending on the specific circumstances. On the voluntary termination right under the Consumer Credit Act, I want to address the practical mechanics, because there is a specific process that must be followed correctly. To exercise your voluntary termination right, you must write to your finance company and state clearly that you wish to voluntarily terminate your agreement under Section 99 of the Consumer Credit Act 1974. Use those exact words. Then arrange to return the vehicle in reasonable condition. Reasonable condition means the vehicle should have no damage beyond fair wear and tear. Fair wear and tear is a legal concept that acknowledges normal aging and use. Surface scratches consistent with normal use, minor stone chips, light interior wear, and similar marks are fair wear and tear. Damage beyond that, including dents, significant scratches, interior damage, or missing components, may be charged to you by the finance company. Before returning the vehicle, document its condition thoroughly with photographs from every angle inside and out. This protects you if the finance company attempts to charge for damage that existed before the return or that constitutes fair wear and tear. Your credit file will show the voluntary termination. Potential future lenders can see this. For a pensioner who is not planning to seek car finance again, this consequence is relatively minor, but it is worth being aware of. On buying a reliable used vehicle for cash, I want to give specific guidance on how to identify reliable models and where to find them in the UK market. The UK equivalent of the US reliability data comes primarily from Which magazine, Auto Express, and the Driver and Vehicle Standards Agency's MOT data, which is publicly available and shows failure rates by make and model. Which publishes an annual reliability survey of UK cars. The models that consistently appear at the top of UK reliability rankings include Toyota Yaris and Corolla, Honda Jazz and Civic, Mazda 2 and 3, and Skoda Octavia and Fabia. For used vehicles, the private sale market through Auto Trader, Gumtree, and local classified adverts typically offers better value than dealership purchases. The FCA car finance situation has made many pensioners cautious about dealership finance, but the dealership as a source of used vehicles without finance is still an option if the price is competitive. Before purchasing any used vehicle privately, obtaining a vehicle history check through HPI or the AA is essential. This confirms whether the vehicle has outstanding finance on it, whether it has been written off, whether the mileage is consistent with its recorded history, and whether it has been stolen. The check costs approximately £15 to £30 and protects against purchasing a vehicle with hidden legal or financial complications. An independent pre-purchase inspection by a mechanic of your choice is also recommended for any used vehicle purchase. The AA and RAC both offer this service for approximately £150 to £250. The inspection identifies any mechanical concerns before you commit and provides negotiating leverage if issues are found. On the Motability scheme specifically, I want to give more detail because this is a benefit that many eligible pensioners have not considered. The Motability scheme allows people receiving the enhanced mobility component of personal independence payment, the higher rate mobility component of disability living allowance, the enhanced rate of the mobility component of adult disability payment in Scotland, or the Armed Forces Independence Payment, to exchange their mobility payment for a vehicle lease. The scheme provides a new vehicle, fully serviced and maintained, with insurance for up to 2 named drivers, breakdown cover, tyre replacement, and vehicle adaptations where needed. The vehicle is replaced every 3 years. The customer pays only the weekly mobility allowance, typically £72.65 per week in 2026, directly from their benefit payment. For most scheme vehicles, there is no additional payment required. For higher specification vehicles, an advance payment is required, but this is a one-time upfront amount rather than a monthly charge. For a pensioner who receives a qualifying mobility benefit, the Motability scheme eliminates car insurance costs, maintenance costs, breakdown cover costs, and the need to fund vehicle replacement, all in exchange for the mobility payment they are already receiving. It is one of the most underutilized benefits available to eligible disabled pensioners. Applications are made through the Motability charity at motability.co.uk or by calling 030 0456 4566. Let me also address the specific issue of how car finance decisions interact with means-tested benefits for lower-income pensioners. If you receive pension credit, your eligibility and the amount you receive depends on your income and savings. A car itself is typically not counted as a capital asset for pension credit purposes, unlike savings or investments. However, if you sell a vehicle and receive a significant sum that is then held as savings, that amount may affect your pension credit entitlement, once it exceeds the £10,000 disregard. Similarly, if you are using savings to purchase a vehicle for cash, the reduction in your savings may actually improve your pension credit position if your savings were previously above the threshold where tariff income applies. This is not a reason to purchase a vehicle unnecessarily, but it is worth understanding as part of the complete financial picture. And for pensioners considering keeping an older vehicle, the free vehicle tax available for vehicles registered before a certain date and certain engine sizes is worth confirming. Vehicles that are over 40 years old receive free vehicle excise duty. Checking whether your vehicle qualifies reduces one of the ongoing costs of ownership. The complete picture for a UK pensioner's vehicle decision in 2026 comes down to one fundamental comparison: the monthly cost of the finance agreement, insurance, and maintenance of a financed vehicle versus the insurance, maintenance, and no finance cost of an older or purchased outright vehicle. In almost every case for a pensioner on a state pension income, the outright or lower cost option produces a significantly more stable monthly financial position. I will see you in the next one.